Right now, somewhere in your banking app, there is a number quietly insulting you. My name is Nick, and if you bank with one of the three biggest banks in America, that number is 1/100th of 1%. Which means my friend Yvette, who has loyally parked $31,000 at the same bank since she was 22, earns $3 a year. 3. Her brother-in-law, Curtis, has almost the same money. Same federal insurance, same zero risk. He earns about $1,350, that is 450 times more, and Curtis is not smarter than Yvette. He filled out a form while half watching a cooking show. 15 minutes, and if your money is sitting where Yvette's is sitting, you are on the wrong side of that number today. Every finance channel on the internet is calling this the Great High Yield Savings Comeback of 2026. It is not a comeback. It is something considerably stranger. And Curtis is going to show you why right after he nearly loses all of it. Quick warning before we start. Every rate I quote today moves, sometimes weekly. So check the live numbers before you act on anything here. I will give you a checklist at the end. Now let's start with your gap, because you almost certainly have one and it's bigger than you'd guess. The best high-yield savings accounts in America right now pay up to 4.5%. That's what you could be earning. The Federal Deposit Insurance Corporation surveys more than 500 institutions and publishes what Americans actually earn instead. That number is 38/100ths of 1%. It hasn't moved since April. So the typical saver earns about 1/12th of what's available. And that's the generous version, because online banks are dragging that average upward. If your money sits at a big brick-and-mortar bank, you're at 1 penny per $100 per year. Leave $100 there for 12 months and you earn a penny. The gumball machine would reject it. Here's why that's worse than boring. Inflation in June ran 3.5%. Core came in at 2.6%. So your money isn't sitting still, it's shrinking. Every year you leave it, it buys you less. Yvette's $31,000 loses roughly $1,000 of purchasing power annually, while her bank hands her $3 for the trouble. Curtis beats inflation by about a point. Same country, same week, same risk. That's the whole story, and almost every video on this topic gets it backwards. Because here's the thing about the comeback narrative. Rates didn't come back. They fell. In the summer of 2023, top accounts paid over 5%. Then the Federal Reserve started cutting, 6 times between September 2024 and the end of 2025. The federal funds target dropped from 5.25 down to 3.5. And banks passed that along to savers immediately, enthusiastically, in full. And by immediately, enthusiastically, in full, I mean they cut your rate faster than they ever raised it. 4.5% today isn't a recovery. It's the tail end of a long, quiet decline. So why is everyone suddenly shouting about savings accounts? 3 reasons. Only one should matter to you. First, the cutting stopped. The Fed has held all year. At the June meeting, 9 of 19 officials projected the next move would be a hike, not a cut. Second, inflation climbed back up, so people started checking whether their money was keeping pace. Yours probably isn't. And third, this is the one that matters, for the first time in about 15 years. A boring savings account beats inflation without you doing anything clever. Not in 2009, not in 2021 when the national average was 0.04% and your savings were quietly evaporating. Right now, boring works. So the comeback isn't that rates got good, it's that they stopped getting worse and people finally looked up. Which leaves you with a much better question. Where has your money been for the last 3 years and who's been keeping the difference? The answer has an unmemorable name. Deposit beta. Deposit beta measures how much of a Fed rate change your bank passes on to you. Fed hikes a full point, your bank raises you half a point, that's a beta of 50%. Simple enough. Here's the part that isn't. Researchers studying U.S. banking data across multiple rate cycles found deposit beta is asymmetric, and the asymmetry runs exactly the direction you'd guess. When the Fed cuts, your bank cuts you fast and cuts you fully. When the Fed hikes, what reaches you is slow, partial, and frequently indistinguishable from zero. You absorb the losses, you wait for the gains. Deloitte politely described deposit pricing as downwards flexible and upwards sticky, which is a very expensive way of saying the elevator only goes down and somebody set the stairs on fire. Now watch what that did to somebody real.